Hello everyone, this is Group C and we will be presenting our tutorial task for FIN241. Myself, Tarun, Harita, Sahita, Tahmid and Khalid will be explaining each question. So coming on to the first question. So the structure of the foreign exchange market basically constitutes of the central bank, commercial banks, brokers, exporters, importers, immigrants, investors, tourists, etc. These are the main players of the foreign market. Their position and place are shown in the figure below. As you can see in the figure, at the bottom of the pyramid are the actual buyers and sellers of the foreign currencies. So they are basically the actual users of the currencies and approach commercial banks to basically buy it. Right above it is the commercial banks, which is the second most important organ of the foreign exchange market. The banks dealing in foreign exchange basically play the role of market makers. The third layer of the pyramid has the foreign exchange brokers. These brokers basically function as a link between the central bank and the commercial banks, and between the actual buyers and commercial banks. And last but not the least, right above it is the central bank of any country is basically the apex body in the organization of the exchange market. They work as the lender of last resort and the custodian of foreign exchange of the country. And when it comes to the foreign exchange market, it is basically a diversified market and it is globally decentralized. And they work in stimulation of over the counter market. It is not a trading platform where the buyer and seller together physically agree on a price to exchange currencies unlike the NYCE. Only the employees of financial institutions in the market in the major financial cities around the world take part in trading on behalf of traders and primarily deal with one another using electronic communications like telephone, computers, etc.
For the next question, how large are the bid-ask spreads in the interbank spot market? What is their purpose? Bid-ask spread is the difference between the buying and selling price of a currency. Major currencies have a percentage spread of 0.05% to 0.07%. The percentage spread is lower for highly liquid currencies and higher for less liquid currencies. The purpose of this spread is so that traders make profits by buying a currency at a low price and selling it at a high price.
Coming to the third question, what was the euro price of the British pound on December 21st, 2010, and why? Now, there are two ways in order to find this out. The first method would be finding the quoted cross rate on December 21st, 2010, which was 1.1818 euro per pound. The second method, which would be finding the exchange rates of euros per dollar and dollars per pound on December 21st, 2010, which are respectively 0.7636 euros per pound, euros per dollar, and 1.5477 dollars per euro. We know that there would be a triangular arbitrage possibility if the cross rate differs from the indirect rate using the dollar as an intermediary. Thus, we find the same value if we calculate 0.7636 pounds per dollar and multiplying it with 1.5477 dollars per pound, which gives us 1.1818 euros per pound.
The fourth question is if the direct euro price of the British pound is higher than the indirect euro price of the British pound using the dollar as a vehicle currency, how could you make a profit by trading these currencies? In the case of the direct euro price of British pound being higher than the indirect euro price of British pound using the dollar as a vehicle currency, a triangular arbitrage would exist. The ideal situation would be to buy pounds at the indirect low price and sell them at a direct high price. The current direct price of the euro per GBP is 1.10. The direct price of the euros per USD is 0.85 and the indirect price of the USD per euros is 1.29.
After recognizing that an arbitrage opportunity exists due to price discrepancies, we shall follow 3 steps to attain an arbitrage profit. Step A would be to sell 1 million euros at the current rate of 0.85 euros per dollar to get 1.17 million USD. Step B would be to convert that 1.17 million USD to get pounds at the current rate of $1.29 per pound to get 911,992 pounds. And the final step would be to convert those 900,000 pounds back to euros at the current rate of 1.10 euros per pound to get 1,003,191 euros. Hence, by doing this, we make an arbitrage profit of 3,191 euros at the end. Through this triangular arbitrage, we understand the act of exploiting an arbitrage opportunity resulting from price discrepancies among three different currencies in the foreign exchange market. Thank you.